So just curious to see how many of us have used these orders previously, which some of the ones we're going to be talking about today. And majority of us use stop loss and profit taker, which is good to see. The other ones, the conditional orders, are not quite used. So hopefully I can shed some light and see if that is something that you may want to incorporate into your trading practice there. All right. So that is out of the way. And let's blow the screen up over here. And let's get rolling. All right, so what do we have on tap here first today? Before we do anything, of course, we have to say a disclaimer. And so the disclaimer I'm going to mention today is that we'll be exploring out advanced dashboard platform. We're going to be talking about orders, and obviously it's going to make a lot more sense when we incorporate some securities as examples. And whenever I do that, keep in mind that's only going to be for informational demonstration and educational purposes only. It doesn't convey in any way, shape, or form any sort of financial, legal, tax, or investment advice, either from myself. What exactly is a market and limit order? Well, in market order, first of all, the feature is what we would like to say is a market order is you the priority is a fill and not price. Okay, so you get a priority on being the order filled, but you're not too concerned with the price at which it gets filled as a trader. Okay, so you really want to say, look, if I want to buy something, I want to buy it right now. Few cents here and there, maybe a few dollars here and there. I'm not too concerned with that. Okay, get me into that position right away, and that's what a market order is. Okay, it gets you into a position right away, and it gets you out of a position right away, but it does not guarantee you on a price, because once the order gets sent and the order gets filled, only once it gets filled will you know what price you ended up either buying the security for or selling the security for. Okay, these orders are always day orders as well, market orders. You don't place them, with a week away from now or 2 weeks away from now. They get filled right away, so therefore they're only going to be set as day orders when you're going to set those orders up. Okay, so just keep in mind a market order is an immediate fill with no priority on price. Okay, by the same token, a limit order is just the opposite of that. In a limit order, the priority is that we want a price. We want a fixed price, but we're not too concerned about getting a fill right away. Okay. So in a limit order, what a trader does is they set the price that they're willing to spend. So if they're putting a buy order, they will decide to say, this is the most I am willing to spend per share on the trade, or this is the least I'm willing to sell my security for. Okay, so when you're putting a buy order as a limit order, it's the highest price you're willing to pay to buy the security for, and when you're placing a limit sell order, it is the lowest price you're willing to sell the order for. Now, just because you're putting that price, remember your fill will when you do get a fill, meaning when the order, if the price in the market matches what you've placed, you're going to get that price or better. Okay, so understand that it's not necessarily just that price you put in, it is that price or better if there's a better price available at that time. Okay, so for example, let's say I'm putting a price of $10 to buy a stock. The stock's currently at $11. It starts falling, and now suddenly it fell from 10.50 to like 9.85. Okay, so as soon as it hits 9.85, that order will be bought, but I'll get to buy the stock at 9.85, even though my price is 10, because I've said the max I'm willing to spend is 10. However, 9.85 is the better price that became available once it hit my threshold there. All right. But remember, the one thing is that there's no guarantee on execution, meaning you could wait a long time potentially for your order to go through, because if you're too aggressive on the price and you're too far away from where the market is with the current stock price, then you may have to wait, a week, 2 weeks, a month, depending on where you're putting your limit price. All right. So this is what market and limit orders are. These two orders basically form the foundation of every other order that we're going to be talking about today. So I just want to make sure everyone understands these a-okay. Okay, so just I'm going to put a little box on up in the chat over here. So is everyone good with market and limit orders? Let me know yes, or if you're unclear about it, let me know, but or put a thumbs up, anything that you want to do. So, and then we'll move on, because it's very important that we all have a good foundation of these orders. Okay, so I'm getting a majority of yeses, so I'm happy to see that. Perfect. All right, let me get that out of the way. Okay, let's talk about a stop loss order now. Stop orders in general. Okay, a stop loss, an order that you may have heard of now. So there's two types of stop orders that we're going to be talking about. One of them is called a stop market order, Commonly, the term you'll hear is just stop loss. Okay, so sometimes on the when in everyday trader lingo, people will just say I put a stop loss on, and if someone just says if they say that I just put a stop loss on, it essentially means they put a stop market order. Okay, by the same token, the other order type of order, of course, is going to be a stop limit order. Now, I want you to think logically. If you're not familiar with what this order is, just remember the words market and limit are in there already, and we just talked about what a market and limit order is. Okay, so just under you already know what the market order and limit order is. I'll explain what the stop order is. When you're placing a stop order, first of all, we'll talk about the stop market order. This is known as a protective order, all right, in general. Whenever a stop order is placed, it's a protective order that is being placed. Now, there's two ways that can be placed. One is if you can place it when it's placing a stop order below the market. So let's say, for instance, you own a stock. You own the stock, and maybe you bought it for $10, and the stock's currently at $12. Now, let's say you want to, you're telling yourself, well, look, I want to protect myself in case the market falls. Okay, I don't want to really stay in the stock if it falls below a certain price. Now, if you and let's say that price you've determined is going to be $9. Okay, you're willing to take a $1 loss based on what you bought it at. So ordinarily you can't place a sell limit order or a sell market order, because if you place a sell market order at this moment, what's going to happen is it's going to sell at the current market price, which is the $12. So how do you place an order below the market price? And that is where a stop order comes in. That's very important. When you want to place an order below the current market price, it's not below your cost at which you bought it. It is the current market price. So the current market price is 12. If I want to place an order to sell it when it hits 11, 10, 9, 8, etc., whatever the case may be, I will use a stop order. All right. So very important. So this is something that's only going to trigger when the stock gets to that price. It doesn't mean just because I'm placing the stop right now at $9 and the stock's at 12, it's going to sell. No, the stock in fact has to come down to that price, and only then will it sell for me. It'll trigger. Okay. So that, and most commonly stop loss orders are used in this manner. They're used to protect you on the downside. That's where a lot of traders use it. There is also certain instances where they also used where they can be placed as a buy order, and commonly when a trader is shorting a stock, remember their obligation is when you've shorted a stock, you have to buy back the stock to close out the position. And so you could also use a stop loss order as a buy in that case. And when you're using it as a buy, you're placing it above the current market price. Okay, that's remember that. So you wouldn't usually use this order to enter into a new position, but rather a stop buy order or stop loss as a buy would be used when you want to close out a short position typically. All right, because remember, when you're shorting a stock, you want the stock to go down to make money, but if it goes up, then you start losing money. And so this is why the logic behind that is it's they'll set a higher price than current market price to say, like, if it goes higher than this, then I want out. I'm going to cut my losses at this point. Okay, so this is what a stop loss order is. Now let me explain the name stop and market. Okay, so the actual word stop, think of it as like an alarm bell. All right, and we'll get to an example in a moment, but think of it as an alarm bell. What it does is it prompts you to take action. Okay, when you have an alarm on, it's prompting you to either you set a reminder for yourself or to wake up. Most commonly, the alarm triggers something and tells us, okay, now we've got to get up. And so a stop order is doing exactly that. The stop itself is a certain price that is just triggering the order. And as soon as the price comes and it triggers it, and sort of the alarms go off, it turns into a market order. All right. And this is what the big difference is between these two orders. Once they both have this kind of alarm or triggers that are going on, and in this order, the order, as soon as it triggers, it turns into a market order to either then sell the stock at whatever price is available. But in this case, in a stop limit order, once the stop price gets activated or triggered, it becomes a limit order, all right, to sell. So now in this type of order, you'll see in just a moment when we look at an example, you are setting two prices up. One is the stop price, which is that trigger price, and then there's going to be a limit price. In a stop loss order, you're just setting one price, which is just the trigger price, and then it becomes a market order, right? So this is what you're going to look at. So let's look at So we'll explore some examples in a moment, but I wanted to talk about advanced orders in a moment, and we'll talk about some what those exactly are. But some of the benefits of using advanced orders when it comes to it are first of all order restrictions. Like it'll bypass certain order restrictions. It'll allow you to place simultaneous orders together to be able to kind of automate them. And that sort of falls in line with how they become efficient and convenient, okay? Because chances are most of us don't want to sit on in front of our computer throughout every minute of every trading day that's available. I'm assuming some of you will go on vacation, take a breather away from the screen. So advanced orders allow you to just automate certain orders and place them and be able to capture key moments when stocks are either moving up or down without you having to stay glued to your screen. All right. And so in that sense, they also allow you to maximize profits because you're able to set parameters where you want to say, look, I want to get out when it gets to this position rather than waiting and looking at the order the whole time, and also allows you to get out and reduce losses potentially by setting those parameters in place in advance. All right. And most importantly, it allows you to seize these opportunities because when you're placing advanced orders in that we're going to be looking at, which are things like conditional orders and trailing stop orders, you're automating a lot of these in place. You're staying disciplined, and this is a big thing with a lot of traders is when you enter a trade, you first of all are you probably figuring out like how long you plan on holding that position, of course, and then at the same token as well, you probably have something set up in mind to say, look, I want to at least capture this much profit and then take some profits off the table if it reaches there, or minimize my loss if it falls to this point. And so by using and knowing about some of these orders, that is going to help you do that, all right, towards your trading there. Okay, so let's talk about a trailing stop market order that I wanted to talk about. Before I do that, I do have a fantastic video that I wanted everyone to see because if you see the video, I think visually it's going to make a lot more sense for me to explain. So I'm just going to play that video. I'm just going to pull it up on screen and then we'll play that together and then we'll go ahead and explain it. So here we go with the video. I'm just going to pause for a moment on the sound.
Let's now look at how a stop loss order and a trailing stop loss order are different. Let's say I hold shares of ABC Corporation. I bought the shares just now at $10 a share, and after buying them I decide if the price drops to $9 or less, I want to sell the shares. Cut my losses, get me out. To do this, I could use a stop loss order at $9. And while my stop loss order is active, the stock's price might dip, it might rise, but should it trade at $9 or less, my stop loss order would get triggered and my order to sell sent to market. Now there are some important details around that, which we'll touch on a little later, but first, let's look at this scenario again, but using a trailing stop order. So again, I buy shares of ABC Corporation today at $10, but this time, instead of entering a stop order to sell if the shares drop to $9 or less, I enter an order to sell if the price drops by $1. Now initially, this results in an order very similar to my stop loss at $9. The price may dip, and the stop loss would remain at $9. But then again, it may also rise. But if the price were to rise above where I entered it, my stop price would follow, remaining $1 below the new higher price. If the price rises again, the stop would again follow. Because this type of stop order can follow the price of the stock, it's called a trailing stop order. And should the price stop rising and start to fall, say falling $1 or more from the new high, then my sell order would get triggered and sent to market.
Everyone able to hear and see that video, hopefully? I'll just wait for some feedback. Hopefully you guys say and let me know if it made sense to you. Hopefully I didn't lose anyone. That video does a great job of explaining what we're talking about. So fantastic. Okay. So thanks. All right. So we're going to talk about our next order now, which is trailing stop market order. And just like the stop order that we just spoke about, remember the stop orders, the stop loss and stop limit order, they were protective orders. Okay, they protect you on the downside, or if you're short a stock on the upside. Okay, you want to get protection from them. The trailing stop orders itself are considered to be profit taking orders, as you just witnessed when we were looking at it there. Okay, and sort of protective as well at the same time, but we'll look at it now. Remember, the common feature in the names of this is always that it is a derivation of a market or limit order. Remember, that is the foundation of all of these orders, is a market and limit order. At the end, just understand this: whenever you see trailing stop market order or limit order, it means that once this order gets triggered, it will become a market order or it will become a limit order on them. All right, let's talk about trailing stop market order. Now, you're probably thinking, well, look, that sounds familiar, stop order, because we already just talked about it, but this is a new piece called trailing. So what exactly is this order? Well, it's used to protect a profit, as I mentioned. It potentially can minimize a loss as well, depending on when you're placing this order in. And this is kind of that whole idea with some of the points that we talked about, the reasons for placing advanced orders, is it avoids you having to sit there and monitor the position constantly. Now, what exactly is this order? Well, it's a modified stop market order. We just talked about a stop market order, and so I'll explain how it's a little bit different. This order can work either for buys or sells. Again, depending whether you're long the position or short the stock, you can still use this order. And the actual stop price that we have in place, that I'll show you on the next chart. We have a chart set up. It'll actually it activates and changes the price on a regular basis, and it'll get reflected and updated on WebBroker kind of once an hour, but it's done constantly in the background while the trades are happening on the exchanges there. All right. And when you're placing this order, there are two ways you can set this order up, either as a percentage or a dollar value. And I'll explain what that is in terms of that difference that we're going to be talking about. And then finally, just remember that once this order triggers, it becomes a market order, as the name suggests, the trading stop market order. So let's actually look at this order. So here's a chart that I have here. And so the situation is that we're looking at a stock that we've bought in at $10, and we want to enter a profit-taking order simultaneously. So I'm going to enter a trailing stop order with a $1 trigger delta on there. Okay. So $1 trigger delta, and delta, for anyone of us who's not too familiar, it's generally a physics term that's used, but it just tells you what is the difference you want from the current price to kind of get out of the stock. So if I say that I'm putting a $1 trigger delta, it means I'm willing to take a $1 loss currently based on the price that I've got into the stock. So that means 10 minus 1 equals 9. Okay, so 9 is my trigger price at this moment in time. It's my alarm clock. Okay, it doesn't mean that that's the price I'm going to sell at. It is just when the order will become triggered, and once it becomes triggered, it becomes a market order. Okay, and we know with a market order, as soon as it becomes a market order, it means whatever price is available at that point after that, that's what I'm going to be able to, my stock will be sold for. All right. Now, the difference between the stop and the trailing stop is the word trailing, and in the sense that what's going to happen is, let's say we've entered our trailing stop right here. It is going to follow the stock and adjust the trigger price each time as the stock goes higher from the original price. Okay, so if it goes up to 15, if it goes up to 20, okay, so let's say the stock goes up to 20, what do you think my trigger price is going to be? So if the stock climbs up to 20 with a trailing stop with a trigger delta of $1, what is my trigger price going to be? Balwin says 19. Perfect. Brian, 19. Exactly. It's a $1 difference. So it follows the stock on the way up only. Okay. Just remember that. Not on the way down, but on the way up only. All right. So the new trigger is at $19. And so you can see as we move along through time, the stock is rising, it rises, and it rises until it reaches a price of $30. Okay. So at this point, we know that at $30, my trigger delta of 1 will be 29. My stop price is set at 29. Now what happens is the stock starts falling. So now it's kind of hitting right at this price. Now what do you guys think is going to happen? At 29, what is my trigger price? at $29, what is my trigger price? Suat says trigger happens based on offer price or the ask price. This is going to be based on the bid price is what the trades go off at. Okay. So Shalom says 28, Kanti says 28, Balwan says 29, Corey says 28. Ooh, this is a trick question, guys. I asked, and I'm going to say, Balwan, you nailed it. Remember what I mentioned, that it will only follow the stock up to the last highest price. So that means $30 was the last highest price. If it starts falling to 29, the trigger will not adjust to 28. It will remain at 29 since the last highest price was $30. So once the stock goes to 29, what's going to happen is the order will get triggered, meaning it'll activate the order and become a market order. And so whatever price is available after it triggers at 29, and it could be either, the stock could slightly go up after that at 29.02, 29.05, or it could fall down to 28.90, 95, who knows? That is when my order is going to get sold as soon as it gets triggered at 29 as a market order. As soon as it triggers, it turns into a market order as a sell, and it'll sell for whatever price is available, and we will be out of the position, okay? So that's how it works there. So hopefully that's clear. Just let me know. So just keep in mind that it's only going to follow the stock up to the last highest price. If it starts coming down, it will not adjust on a lower price, okay? It'll only adjust on a higher price when it goes up there, okay? So just keep that in mind when you're doing this. All right, DC says, makes sense, great explanation, thank you. Looking to learn how to actually place a trading stop on advanced dashboard specifically for options, having a hard time finding out how. I will definitely show you when we'll talk. I'll reserve that for the second hour at DC, but I'll try and show you just on a stock how it works, and then it's going to be kind of similar. There's some limitations with options, so this may not work just because of the volatility that's associated with option prices that are available there. All right. So this is the trailing stop market order that we just talked about. All right. Is there any questions before we move on to trailing stop limit order that we're going to be talking about next about this specifically? All right. So just keep in mind the features of a trailing stop is, first of all, you've got to set up a trigger delta. Okay. The trigger delta can be either set as a dollar value or a percentage. Okay. In this case, we set it up as a $1 difference. You could make it 20 cents. You could make it 50 cents. I could make it 5%, 10%, whatever I wanted it to be. But it can be done either as a percentage or a dollar value. And then it's just, you just ask yourself and say, what's the most I'm willing to lose? So in this case, the trader said, look, I'm willing to take a dollar hit based on my current price that I've entered in. And it could be the case because let's say, we entered here and the stock could have gone down instead of rising up. I mean, we caught it right at the pivot. But if it went down, what would have happened was the adjustment wouldn't have adjusted because the stock went down from the time we entered it. And we would have, if it kept falling down, we could have been out at $9 had the stock gone down, okay? So just keep that in mind. The other rule to keep in mind is a trailing stop. It's only going to follow the stock as the stock climbs up to a new higher price, and it'll adjust until it's reached its highest price. But once it starts falling from the highest price, no more adjustments happen on that stop price, okay? Until it starts climbing back again if it doesn't trigger. Now, I will explain this just here just one more time. Let's say at $30, we had the stop price set at 29. Our trigger was at $29. Let's say the stock dropped to 29.50. What do you think will happen in that case? What is going to be our trigger price? Let's say the stock dropped to 29.50. What will our trigger price be in that case? So I'm curious to see. Bill says 29. All right, I'll see Fardin is typing. See a few more answers. See 29 as well. Okay, Suat Kanti. Exactly. You guys got it. It will not adjust because that's a lower price from the highest price now. It's not gonna adjust. It also means we're not gonna be sold out just yet because the stock hasn't come down to 29, which is our trigger. If it then starts climbing up from 29.50 again to go up higher, let's say it goes to 31, now what do you think our price is going to be? What is our trigger price if the stock climbed up from there to 31? What will our trigger price? 30. You guys got it. Okay. I want to do this exercise because just to make sure everyone's clear on it. Because now the stock has climbed to a new higher price, it is going to start adjusting the trigger again for us, making with that $1 difference. Okay, so brilliant. All right, let's go on and I just had a visual. Let's talk about the stop limit order. Now, the only difference between what we just talked about is going to be is just oops, this thing has a mind of its own. The only difference is going to be that when we talked about the stop market order, oops, let me go back to this one here. The stop limit order, rather, I should mention, is that instead of the order becoming a limit order once it triggers, sorry, a market order once it triggers, it is going to become a limit order. All right. So in this order type, you're setting two different prices up. You're setting one trigger price. So that's that delta. What's the difference you want for the trigger? And then once the order triggers, it will become a limit order. So you know with limit orders, you always have to say what price you are willing to sell the stock for, and so you'll set a limit price as well off of that, and I'll show you how that works. Okay, so it's the same idea. It's still you're protecting. It's used to minimize losses. Really nothing different from how it works there in terms of execution. The only difference is you now set a second price up for your limit price there. Okay, so what we have over here now is in this scenario, and sorry, this should say stop limit order. No, I don't know why it says market order. But on this chart, we're still buying. We've got the stock at $10, which we bought it. We're going to set up a trailing stop order. We're going to set up a trigger with a $2 trigger delta. Okay, $2 trigger delta in this case. And so what does that mean? It means that our initial trigger price is going to be $8. And we've also then further set a $1 limit delta. And this is how you would set the limit price up. It's basically a difference off of the trigger price that you want to say, look, this is the absolute lowest price that I'm willing to sell my stock for. So in this case, it's $1 difference from that. So it's going to be $7. Okay, so remember, off of 10 minus 2 is $8, which is our trigger price. And then the limit price is going to be $1 off of this trigger delta, which is going to be $7. Okay, and so this is how it works. So initially, if the stock, let's say the stock were to fall down and it fell down to $8 down here, our order would trigger and it would become a limit order to sell at 7, and provided that the price is $7 or better. Remember, once it triggers at 8, there's a huge $1 range, so the next price could be like $7.94 or $7.90. I will get that better price. It doesn't mean I'm just going to only sell at 7. It's just when it becomes a limit order, it's just saying that I'm willing to sell it for $7 and no less. Okay, but I will take a better price. All right, so just remember that. And Suat says trigger is based on ask price or the offer price. It's going to be based on the offer price, Suat, the bid. Okay, so it's going to be based off the bid or the offer price is what you're looking at whenever you're placing a sell. It's going to look at it that way. All right, Bill says, so you can lose $3. Yes, in this case, this trader has intentionally decided that their risk threshold is going to be $3. They're willing to stay in the position as long as they're not taking more than a $3 potential loss on this position, okay? But this is just an example. You don't have to do 3. Like you could easily say we will do a 50-cent trigger and maybe a $1 limit delta off of that, okay? Perfectly fine. So this is just a kind of an example we want to give to have even whole numbers to make it easier. Okay, so now what happens is the stock goes up to the same level as it did previously. So it goes up to $30. Now with $30, I don't know if everyone's seen this. What do you think our new price parameters are going to be? And I'm going to clear this out, or you can use the chat. At $30, with our trigger delta of 2 and our limit delta of 1, type in the chat or use the open forum box and let me know what's our trigger price and what's going to be our limit price. So let me know what you guys think if when it reaches $30 there, okay? So limit at 29, trigger at 28. Suat says 28 and 27. Okay, 28 trigger, 27 limit. Perfect, perfect. Yep, you guys nailed it right on the head. All right, so that is correct. Remember, it's a $2 trigger delta. Where in the previous example we used 1, so I can understand why someone might have said 29 and 28. But remember, it's $2. So $2, 30 minus 2 equals 28, and $1 difference from 28 is 27. Okay, so now what's going to happen is the stock falls and it's going one-way direction. The stock first triggers at 28. So now what happens is as soon as it triggers at 28, it becomes a limit order to sell at 27. Remember, the rule is that as long as the next price available after it triggers is 27 or better, then my stock will be sold. Now that better price could be it. The stock could turn and go slightly up to 28.05, 28.10, or it could go down to 27.90, 94, 27.50, 60, whatever the case may be. But the next traded price, the next tick, what we say is the price we're going to sell for. As long as it's more than 27, I'm going to have it sold. Okay. So I know someone asked a question, Balon says, so it'll not sell below 7. Yes. In this case, Balon, in the beginning, yes, it will never sell below 7. But as the stock goes up, then it's adjusting. So now at the highest price, it will not sell anything below 27. Now, the one thing I will mention to everyone where you have to watch out for is, let's say it gaps down, the stock gaps down. So once it crosses 20, let's say it triggers at 28 and the next price becomes available, next price available is like, let's say 26.90. What do you think will happen in that case? Will my stock be sold? Yes, or it will not be sold? No. So yes or no. Dave says you hold the bag. Zhao says yes, it will be sold. Bawan says no, it won't be sold. Bill says no. The answer is no. And this is kind of why you have to be careful with these limit orders, because if it does gap down, you're going to be holding, you're going to be left holding that stock, and you would have asked yourself, well, what the heck happened? Why didn't it sell? Well, because once it triggered at 28, remember that's the trigger price, it's not the sell price. The next price that traded after 28 was 26.90. And remember, your limit order said that you're only willing to take accept 27 or better, and 26.90 is not more than 27. So in this case, the order is saying, well, look, the trader wants to stay in this position because they don't want any lower price than that. So in this case, we're going to keep holding that position. And in that case, if you weren't monitoring it, you would have gone all the way down for the ride, along with that. Okay, and the order would have still been there trying to get to 27. But if the stock never climbed back up, you would have in fact incurred a loss. Okay, so very important when you're setting your trigger price up, your limit price, you're aware of how close you're setting that limit delta to the trigger price. Okay, if it's very, very close and a gap down event can happen, then you potentially might be still left with holding that stock. Okay, so just keep that in mind. If you never want to run into that risk where you're just like, I just really don't want to worry about that, then consider using a market order where it'll get you out of that position. But remember, you're not guaranteed on a price. If this was a market order, and that event happened where there was a gap down at 28, it triggered, you would have got 26.90, but you would have been out. It may not have been your ideal price, but you would have been out of that trade. All right. All right. Suat says if 28 was offer price trade should happen if it was one lot, right? Yeah. So lots don't matter. Like, I mean, it's going to give you a fill regardless. It's not looking to fill you on the entirety of the shares. Whatever comes available at the offer price, if it's a single lot or two lots or whatever the case, it's still going to get you some sort of fill, provided the next price is better than the $27 there. All right. Limits are open to gaps, therefore no execution if your price is not touched. Exactly, Bill. You said it right. Dave says can happen on stocks with large bid-ask spreads too. Exactly. So what we consider to be illiquid stocks, so that don't get traded a whole lot. You'll notice there might be a big spread between the bid and ask. You always want to be cautious about those. And if you're still wanting to trade those, just be aware of what that spread is and maybe adjust your limit delta accordingly so that it kind of still stays in line, hopefully. But remember, by doing that, you're still taking more of a loss. All right. All right. Zhao says, but how can the price can go to 26.90 without passing 27? Zhao, in our marketplace, it's an auction marketplace. It's not systemized where it just trades 1 cent by 1 cent. If there's some bad news that happens on a stock, suddenly the market outlook has changed on the stock and the valuation has dropped. It can drop really big time, very quickly. And so the next price that traders are willing to only pay for the stock can be significantly lower there. All right. And Bill mentioned it because there might not even be a seller willing to sell at that 27 price. So just keep that in mind. It doesn't occur a whole lot. I'm giving an extreme example, but there are events known as gap up and gap down where this can happen there. All right. So hopefully that explains it. All right. So that is it for the trailing stop. So of course, then the last point we just wanted to make. So once it hits this price, as soon as it crosses 28, it's going to trigger and we'll have a limit at 27. So provided we have 27 or better on the next tick or next price that gets traded, we are going to be out of our position at that point. Okay. Bashir says, what happens if the stock drops momentarily below 28 and goes up without an order executed? Bashir, as soon as it goes below 28, that order has been triggered. It has now, it's no more a trailing order. It is now just a limit order. As soon as it reaches 28 in price, it is going to become a limit order to sell at 27. So provided if the prices do go back up after that breach, it's going to sell you out and it's going to get you that slightly higher price if it went back up to 28 and change at that point. Okay, but you are going to be, as soon as that order triggers, it has now become a limit order to sell at that point. Duration can be it can be day, it can be a week, it can be a month. There's no limits to the duration on these trailing stops. So it's however long you want to do it, as up to the maximum allowable time frame that the order allows there. All right, so let's talk about advanced orders, and I just wanted to kind of just jump on this, and we'll look at live examples on advanced dashboards. So we'll go through some more scenarios and questions if you have them. But let's talk about advanced orders. These advanced orders are also known as conditional orders. Now, all of these conditional orders, advanced orders, they're not new orders I'm going to teach you. They're basically now just piling up the orders that we already know in various ways. Okay, so things like market, limit, stop order, and trailing orders. Okay, trailing stop orders. We're just going to be combining them in different ways now to allow for maximum efficiency when it comes to executing those orders. So the ones we're going to talk about today are going to be specifically one triggers another. Also, for short, we call this OTA, one triggers another. OCO, one cancels other order. And the last one is going to be first triggers OCO order there, FTO, okay? You're probably seeing this one. Don't worry about this. Multi-leg, this has to do with options, so I'm not going to go into that in this session here. So OTA, OCO, and FTO are the orders we're going to look at. Now, these orders, by the way, this screenshot we've taken is from WebBroker. So you can place these orders on WebBroker, but as I said, I'll show you how you can do these orders on Advanced Dashboard when we get to it. But let's talk about these orders specifically there. All right. Just before I do that, Suat says duration. Sorry, Bill says max duration. Is it not 90 days? Bill, good question. Fantastic question. So the duration on the order type depends on the market on which you're trading. All right. So in the Canadian market, the maximum allowable time frame is 90 days. But on the US market is different. Anyone has have a guess on what the duration is in the US, or in fact know what the duration of the max time frame is on the US markets? Let me see if you guys know this. Kanti, 180 days. Perfect. That's correct. 180 days. If you want the maximum time frame, the easiest way to do it is you place a good till canceled order, good till cancel. That gives you the maximum time frame. So if it's a Canadian stock, it's assumed it's going to be 90 days. If it's a US stock, it's going to be 180 days there for you. Okay. All right. So let's talk about so is this after the trigger? No. This is once you actually place that order, the trigger. It's not from the point when it gets triggered. It's when you place that order. It counts those amount of days there. Okay. So even if it does trigger like a week into the order and you've got it for good till cancel, but it never let's say we have a gap down event and you're just waiting for it to come back up again, it'll still remain, the limit order will still remain up until that 190-day period. It doesn't start from the trigger. It starts from when you place that order. That's what's important. Okay. Yeah, so in Canadian markets, after 90 days, if it hasn't been triggered or anything like that, it's going to expire. You'll have to reset up that order again. Okay. Bill says these are called bracket orders. Yeah. So some pockets of the investment industry, they call these bracket orders as well, conditional or bracket orders, whatever you want to consider. And I'll explain visually for everyone why they call bracket orders in a moment there. Let's talk about an OTA order. So in an OTA order, these orders are multiple orders placed together now. In OTA and OCA, there are going to be two orders that are put together, and I'll explain what the difference is. But just remember, there's two orders placed in there. And with the OTA, first of all, just remember the name. Think of the name, what it means. One triggers another. And this means that the first order is going to be your primary order. And only once that first order triggers or gets executed, not placed. Remember, I'm making the distinction. It doesn't just mean when it gets placed, but rather when it gets executed or filled. All right. Then only will the second order become active. All right. And that's when, and so these orders can be used for both Canadian and US equities and options together as well. And again, I'll reserve the options one to show that in the second half. And so when would you use an OTA order? Well, here's some examples when you want to buy low and sell high. Let's say you place a buy order to enter into a stock at $10, and now I want to place my second order as a limit order to sell when it gets to 15. That's an example of an OTA. I'm not waiting for that, unlike if you don't use an OTA order, then you usually put your buy in and then you wait for the fill to happen, and maybe that happens a week later. Then you go in and place your sell to do at 15. So now you have to keep waiting. But with using an OTA, it simultaneously allows us to put that sell order in together with the buy, okay? You could also use it when you want to buy a certain stock and then set up a second buy order to buy even more at a lower price. So example, we want to buy at $10. I'm going to set my second order now to say buy some more, but make this price at $8 if it gets there, okay? Limit price of $8 in this case, all right? So only once the first order goes through, then only will the second order become active to buy the rest of the more of those shares there, all right? And then of course, we can use it to protect on the downside, all right? So if we put a buy order as our primary order, and on the second order, we could use a stop loss order to protect us on the downside, all right? So it gets triggered. And so we've got an example here of just a plain vanilla one that's used commonly, buy 100 shares of XYZ at 25, which is our primary order. And then once this gets filled, the second order is to sell XYZ then at $27 once it climbs up there, okay? So a lot of traders, a lot of swing traders, day traders, they incorporate these orders as part of their practice. Even long-term traders, if you don't want to be susceptible to market volatility, markets can go down and up very quickly. So these are just ways of taking profits and reducing our exposure to risk as well on the downside. All right. Now, the next order type is OCO. Again, two orders here that are put together, all right, in an OCO. What does this stand for? One cancels the other. The big difference between this and an OTA, in an OTA order that we just talked about, there is a primary order, meaning that order rules over the other order. Only once the primary order executes, then only the second order becomes active, okay, and working on the market. Until then, it's kind of sleeping. It's just dormant until that first primary order doesn't, until it gets activated. In this situation, in an OCA, you're putting two orders in, and both of them are active at the same time. They both go in and they're working on the market at the exact same time. That's the difference. It's not waiting now for one order to execute and then only the other order will kind of become active from being in its dormant state. Both orders are active. Now, what is the difference? So it works for both Canadian and US options. More importantly, OCO is not available for options, okay? So you cannot place this for when it comes to options trading, just because of the volatility of the prices and how close they can trade to each other. And market orders cannot be used when it comes to OCOs, okay? So you would be just using just market orders exclusively. It doesn't. You can still use things like stop market orders and trailing stop market orders and limit order, of course. All right. When would you use this? Well, most commonly, let's say you've entered into a position already from a previous time. I've gone into a stock and I bought it at $50, for example. I want to place an OCO where I want to protect me on the downside, but I also want to take profits on the top side. So I'll look at placing an OCO order, and I may look at placing one order that's at a limit price, let's say at $60 to sell at if it climbs up there. And the second order I want to place is a stop order to say, let's say if it goes down to 45, then get me out of that position. I don't want to stay in it. I'll take the loss and I'll move on to another trade. Okay. So sell at a limit or sell at a stop is commonly what it's used. It can also be used to buy at a low price and sell at a high price. Okay. So if you already own the stock and maybe you want to say, look, I want to buy some more of the stock if it climbs down below. If it doesn't get down below, then I just want to sell the stock that I already have at a higher price. Okay. So we can do that. And I'll show you a visual next here of kind of what this OCO looks like. So this is what we have. Let's say we have the current stock price at 55. I'm going to place an OCO order. My first order is going to be a limit price, a limit order to sell at 65. And my second order is going to be a stop market, also known as a stop loss order to sell at $45. Okay. Now, what happens is because both orders are active, you're probably asking, well, do they both stay on the whole time? No, it's kind of a race from there at that point to see where is the stock going to go to. Is it going to go to the $65 price first, or is it going to go to the $45 price first? So whichever way the stock gets to first, that order will execute Once that order executes, that other second order then automatically gets canceled out. Okay, and so that's where that name comes in. One cancels other. All right. So just keep that in mind when we're talking about this order. So if it goes to 65, it'll sell me out at 65 and cancel this out. If it otherwise, if it goes to 45 first, it's going to stop me out and get me out at 45, and then this order gets canceled out there. Okay, that's an OCO order. All right, and finally, we're going to talk about first triggers. First triggers OCO. First triggers OCO is what it's called. First triggers OCO. One cancels other. We just talked about one cancels other. The difference between this order compared to the other two, is in this order there's three orders that we're placing. No, it's not very hard. It's very simple. The only difference is we know that the name is first triggers OCO, one cancels the other. We just talked about an OCO, so you already know what an OCO is. What's the only difference? The only difference is that the first order that we're placing in there is going to be the primary order, and once that primary order gets activated once the primary order gets executed or filled, then it'll activate the OCO part of the order, okay, the other two orders that we have. All right, so you're placing three orders simultaneously together. And so and one big difference is one thing to keep in mind when you're choosing the time frame for these orders, they all have to be identical. So if you're choosing a day order, the OCO has to be a day, and on both sides, of course, as well. And in this case, market orders can be used for the primary order, but not for the OCO. Remember, market orders are not allowed for OCO at all. But in this case, because we have one primary order that is going to activate the OCO, that can be set up as a market order if we wish to do so. All right. So when is it commonly used? Is when you want to buy low. Let's say you put your primary orders to buy low, and then you want to set up your OCO to then sell high, or sell as a stop on the low on the downside. Okay, so you can look at that. All right, and so here's an example that we used, that the first order is a buy. Let's say we want to buy 100 shares at a $55 trigger price. So that's our primary order. Only once that first buy order goes through, meaning it gets executed, then it'll activate my OCO, which is now to say, look, I want to sell my 100 shares now at either 65, it gets up there now, or get me out at a stop me out at 45 if it falls down there. Okay, so from there it's kind of that same idea. It's a race. Wherever the stock gets to after that, it's going to get me out at either one of those prices. So that's what a first triggers OCO is. It's just one additional order that is just that's activating the OCO. That's all we're doing once it gets executed there. All right. Okay, so we're going to go to the dashboard. I'm going to spend about 10 minutes in there, and we're going to explore these orders. Let me see if there's any questions here. Farden says, does OTO always being placed with a limit order, or the second order could be a market order? Generally, when you're doing an OTA, you can place it as a market order. It's not always done as a limit order, but remember, you can get executed right away on that market order and it'll activate the second order. So, but in the OTO case, you can place it as a market order if you wish to do so there. All right. So what I'm going to do from here is I'm going to go into screen share mode here. So let me load it up. I've got advanced dashboard opened up here. And just let me know if it distorts the sound, because I know sometimes it can tend to make the sound fuzzy. All right, so I'm in Web Broker. I've already launched dashboard up here. I've already got it opened up here. I'm just going to make sure I have the screen viewable so I can keep an eye on the chat. Okay, so here's advanced dashboard, and what I wanted to start off with is just first taking everyone through just the basic orders we talked about, right? I've created I'm on the trade tab over here under order entry. Keep in mind with advanced dashboard, you can set up orders. You don't have to just be on one screen. Like on Web Broker, you have to go to buy and sell and place your orders. On advanced dashboard, you can do it anywhere really where there's a quote. Okay, there's a floating trade box, and I'll show you in a moment to demonstrate. But I'm just going to do it off of this screen here. What you're going to notice first is first obviously choose the account you want to trade in. I'm just going to stick it as a US account. I will ask you guys now, just any symbols that you guys want to throw out at me, just throw them in the chat. Let me know if you want to look at any symbols. I've got Apple up here, so I'm going to just start with Apple. So we know if you want to do a limit order, it's pretty straightforward. You got the buy and sell button here. You got price type here, so you can choose between market, limit, stop, the whole gambit, okay? I'm not going to explore market and limit because I think everyone is pretty good with that. But let's say we want to do a stop order. Remember the rule with the stop orders, right? When you're doing a buy, you would typically only do it if you're short the stock. So if we were short Apple, then we would use it as a buy. But it always has to be placed above the market price when you're doing it a buy. Okay. So when I'm putting a stop price, okay, let's say stop market over here, I have to place my trigger at Apple's trading right now at 177. If you guys can see here, there's a live bid and ask on advanced dashboards. It'll keep updating. But I can, if I want to place as a buy stop order, I'd be doing, let's say, 180. Now you're probably asking me, well, what the heck does that mean? And now remember, as I said, you typically will not do this when you want to enter into a position using this order, because it doesn't make a whole lot of sense. Because what we're trying to say here is only when the stock goes to 180, that's when I want to buy the stock of Apple. Okay. Now, some technical traders who are technicians and look at technical analysis, they'll maybe see a breakout level at that price. So if they identify and say, look, if it breaches 180, it's going to go up from there. So that's why they may do it. But most commonly it's used as a short, to cover a short position. All right. So this is in the case of when it's used as a buy, but we typically use it in the case of a sell. And so now in the case of a sell, the rule is that you have to place your stop order at or below the current market price. Okay. And so we're talking about the bid price in general over here. So in this case, I can place it. I can place a sell at 170, 175, whatever the case may be. As long as it's below the current price, this stop order will be valid. Now it doesn't mean just because I'm placing this, it's going to sell. Just remember, it's only going to trigger if it falls down to this price. So when you're doing a stop market, you're just setting a trigger price, and all it's saying is if the bid falls down to once it hits 175, this order will become active and become a market order, and it'll sell my Apple shares at whatever is the next price available then. Okay, so that's what this stop market is. If you do a stop limit and we choose this, now you'll see that I have both a trigger price and a limit price to choose from. So in the case of this, let's say I choose my trigger at 175, and I could put my limit price. Here's a question for all of you guys. My limit price, can I put it above 175 or does it have to be below 175? What do you guys think? Can it be above or does it have to only be below? Bashir says it has to be below. Zhao says it has to be below. Below. Oh, Suat says that was the question I had asked. I'm sorry, I missed your question. This is a trick question. Maybe I saved it for later, Suat. Alan says it'll sell right away. So here's the answer. This is a trick question for all of you folks. This limit price is independent from the trigger price, okay? When you're doing a stop limit, you can put it higher, 180. You can put it lower, of course. We know we can put it lower, 173. There is no rule. Just remember this. What is this order doing? Once it triggers at 175, let's say I've got this going on here. I've got this set up. What do you think will happen? Actually, let me do this. Let me do this 177 because that's where the stock is. All right, what do you think is going to happen here, guys? Is my stock if this stock's at 177 and it falls to, let's say the stock drops to 177, will I be sold out at 177 at that point? Won't get filled. DC says won't get filled. Okay. No, exactly. So remember this. This trigger price is the all-important price. Regardless of where I set my limit price up, this will not activate the limit price until it gets triggered. Always remember that. This is the primary order. It has to trigger in order for the limit order to become active. So the stock has to go to 175. Once it gets to 175, now it becomes a limit order at 177. So now what I've said as a trader, I've said, look, if it falls to 175, I want no less than 177. So what I'm doing is I'm taking a gamble or a bet to say, like, I expect Apple to go back up at 177 at some point thereafter, but it will not sell until it does that. So I'm taking a risk because it could continue falling and I could never be sold out of my position by setting at a higher price, or it could in fact go up and I could actually get the price that I really wanted to. But just remember this, that you can place the limit price at or below the trigger price. In fact, you can even make it equal to the trigger price as well if you wanted to. In this case, let me know, guys, if it triggers at 175, then the next price becomes 174.80. will I get filled or not? In this case, what's going to happen? Am I going to get filled? Dave says no. That's right. That's exactly right. So remember, because it this just because it activates at this price, this is not the price we're selling it at yet. It has to trigger first, and then the next price that becomes available has to be 175 or better. So provided that happens, that's when it'll get sold for. All right. So keep that in mind. So we've explored that. If we want to do a trailing stop, the way this works, so when you set up a trailing stop, you'll see it says either trailing stop market or trailing stop limit. We already went through it. Remember how this order allows you to either set it up as a dollar or percentage? You can just toggle between the two signs, whatever you want it to be. And so let's assume we have, let's say we bought Apple like at $160 a while ago. Okay, and now I want to enter my trailing stop to say, okay, it's kind of on the uptrend. I want to take profits. What I'm going to do here is when I'm setting my trigger delta, I'm going to choose the difference based on the current price at what I want to do it. Okay, it's not based on what you paid. It's based whenever you put this order in, it's going to be based off the current price it's at right now. So maybe I'm going to do a $2 trigger delta here. Now, as soon as you enter that, you'll notice that Advanced Dashboard calculates it for you, and you'll notice it's moving 175.81, and it's taking the bid price. It's going off of the bid price there. Okay, so it's moving in real time. And so this is just a trigger delta. So what this means is it'll follow the stock up as it keeps rising once I place the stock, but it will not reset the trigger price on the way down. Okay, just keep that in mind. It only follows it on the way up. All right. You could equally do as a percentage. Maybe I want to do 5%. And so if I do 5% in this case, now the estimated trigger price is 168.90. So from here, if the stock falls, if it continues falling, remember this is a locked in price because it doesn't follow it on the way down. And if it gets down to 168.80 or so, then it'll trigger it and it'll be sold as a market order since this is a market order. Okay. If we do it as a trailing stop limit delta, you could do it the 5%. Now, when you do the limit price delta, it's going to be fixed at dollar. You can't do it as a percentage of another percentage. So this one's just going to be a dollar. So basically, you would look at this number and say, okay, well, from this price, I'm going to do a delta of maybe 50 cents. Okay, a limit delta of 50 cents, and so that's taking 50 cents difference off of the trigger price there when you're setting it up. All right, when you want to do that. I just want to see if it doesn't take negative values, but so you always, whenever you set this order up, it's always going to be at or below. Like you could set it up as 0, like I could just do $0, but that's basically aligning it right to the trigger price when you're doing a limit delta. So it's setting this limit price at this price whenever it does trigger. So you could do that, but it has to be if it's a positive number, it's going to be, let's say it's 25 cents, it's 25 cents difference from this price there based on the current percentage. All right. So this is how you set up the trailing stop limit order. Okay, so that's the only difference. You just how we explain the duration. As I mentioned, you can set up any duration. Good till date allows you to choose a specific date. Otherwise, you can do good till cancel. Since it's a US stock, it's going to be good for 180 days on there. All right. DC says same process for options. Yes, same process for options. However, trailing stop is not available for options. Okay, just the stop limit is only available. So when it comes to options trading, market limit and stop limit are the only order types available. Just again, with the aggressive and volatile prices of options, these are not available. And also, one thing I'll also mention on certain penny stocks on the markets, they don't accept trailing stops and stop orders. You'll notice that as well. So on the OTC market in the United States, the penny stock market or the gray market, they don't accept these type of orders just because they're so volatile. You'll have so many triggers happening all the time. So this is only going to be on major stocks. By and large, these are going to be that'll work for there. All right. Yeah, Bill says technical stop makes more sense than a percentage or dollar amount. Yeah, absolutely. I mean, again, it depends on what your analysis is like. So you would look at that threshold there. DC said that's what I thought. Do you know why? I think Thinkorswim has it available for options. Thinkorswim does have it for some options from what I know, but I think I'm not sure about the trailing stop ones. It's just on our end or with the exchanges over here that the way we handle the orders, it's just options jump a lot. Like you're talking about, they're priced as cents, right? Penny, some dollars and cents, and they move quite a bit. The spreads are big and they can jump around quite a lot. And so you'll just be having a lot of triggers happening, and potentially you could have a very widespread trigger as well happen on you that could give you a bad stop on a potential stock. So they're just limited to these platforms to just limit orders and eliminated the trailing aspect of it at least. Yeah. Okay, so let me talk about the conditional orders, so also known as bracket orders that we talked about. And so to set those up, it's fairly simple over here. So you'll notice there's two little check boxes. And so first of all, I'm going to hit this checkbox here, which is the first one, and it says attach profit loss exits. Okay, so this now when you do that, you'll notice the two sub orders that come up over here. And so you could either just do a profit order, attach profit order. So let's say in this case, I'm going to do a attach profit taker order, and I'm going to do, sorry, I'm going to switch this to a buy, and I'm going to switch this to 165. Okay, and I'm going to make this a limit order at I don't know, 175. Okay. So what type of order have I created out of the three that we talked about? OTA, OCO, FTO. What have I just done over here, guys? What do you guys think? So I've just set this order up. I've just only checked off this first one over here. So which out of an OTO, OCO, or FTO, which one is this? Xiao says OTA. Exactly. Oh, DC says OCO. Okay. We'll try and clarify. So Zhao, you are right, and whoever said OTA, that's correct. Remember this, I'm only setting two orders up. I haven't checked this one up here. I've just checked these two. So what I'm saying over here is this is a primary order, and you'll know this is a primary order because you'll see this kind of arrow. It connects this order to this order. And whenever you see this kind of connection, it tells you that this is a primary order. Okay. All right, so this is the primary order, and only once my order gets bought at 165, so Apple, so it'll have to go down to 165, then this order gets executed, then only will it activate my profit order to sell my shares then for 175. Okay, until then, this is kind of sleeping, it's dormant. I can place this order together, it's sent together, but it just allows me to kind of set it and put it away, once I've got that in place. So this is an OTA order, but this is attached profit loss. Now, to your question, DC, if I did turn on this order now what type of order is this? Well, this is three orders in here. And the only order that has three orders is FTO. Okay, so I've got my primary order, I've got and now this is an OCO. Now you'll notice this is an OCO because it says or. You see this right over here? It's either I of these two orders. So over here now, what I'm going to do is it's set up as a stop loss trigger limit. Okay, so I can either do a stop loss to say, okay, at 155 I want out on this price, and then maybe absolute limit price will be like 154. Okay, $1 difference from there. Now, one big difference with profit loss when you're setting this up, it is going to match the symbol. So you can see I can't click the buy and sell button. They're blocked off for me over here because it's based on what I have set up up here. The quantity is, I can adjust the quantity if need be. Okay, so maybe if I'm buying 20, I don't necessarily need to sell all 20. Maybe I just want to sell 10 of my 20. Okay, at 175. And same thing over here. Maybe I only want to get rid of 10 of half my position at a loss. Okay, so you can adjust that. You can of course adjust the price. This is fixed. The duration is fixed. It's going to be the same duration that's chosen over here. All right. So keep that in mind. All right. One thing you'll notice that there's one other order popping up here which says day plus extended. So in the US markets, there's extended trading session. Keep in mind extended hours. If you choose this order is not allowed to be set up. Okay. This one won't be allowed to be chosen. Reason is that extended hours only accepts limit prices only. Okay, no stops, no trailing stops. So you can do an OTA order as long as it's just a limit order. Okay, in this case, it is a limit order. It says it right over here. Okay, we can't do a stop loss. It won't work. It'll reject the order if I try and do that. Okay. You can also just turn off this and just do the bottom order, just the stop. Let's say I want to put the primary order and just protect myself on the downside. I don't want. I'll stay in the position if it goes up. I don't mind. Take as many profits as I can. But if it falls down, then I want out. So you can just do this. So you can check it off there. All right. Now, the one difference between attached profit loss and conditional orders is you're going to notice that, remember how I mentioned that some of these things are kind of grayed out? In a conditional order, it kind of changes things. It allows you to now kind of mix and match a whole bunch of things. So now what I have here is You select conditional orders. You can then choose a drop down. It'll give you OCO, OTO, and FTO. Okay, just as we learned. So let's say with OTO, let's say I want to do this. One triggers another. Let's say I have, let's say I want to sell Apple. Maybe I have 20 shares of Apple and I want to get rid of it. So I'm going to say, look, I want to sell my Apple at 180. Sorry, 180 when it gets there. But I want to rotate my position. So I want to get out of Apple and maybe I want to go into Facebook. Okay, so now I could say this. I could actually create a completely different symbol, and I could go to Facebook, or I guess it's called Meta Platforms now, and I could go to Meta Platforms and say, look, buy me Meta Platforms, and buy me. I want to keep the. You could either adjust it by dollar weighting or just keep the same shares. So I'm just going to keep the same. Well, it's almost roughly the same, double the price. So I'm going to do 10 shares, and I'm going to say, look, buy me Meta when it gets to $330. Okay. So what I'm trying to do over here is I'm trying to rotate into from one position and into another. So I'm going to say, this is my primary order, OTA, sell my Apple at 180. Once it sells, I want to use those proceeds to then go ahead and buy Meta or Facebook as we know it, 10 shares at 330. Okay. And again, the duration is locked because it always has to match with this duration. So you can adjust this. So if you want to put good till cancel, it'll match up there. But you can adjust what type of price type we're doing here now, all right? So we're not limited. In attached profit loss, it was fixed. You know, the profit taker was a limit price. It was fixed. You couldn't change it. And in the protective order, it was a trigger delta. It was a stop loss, stop limit order. But here I can choose anything here now. So I can either make it a stop limit. I can make it trailing stop if I wanted to. I'm just going to stick to limit because I want to buy it for a lower price. So you can do that, right? We could also, you'll notice in the profit, if I go back here, there wasn't a trailing stop. So if I wanted to add the trailing stop, I would have to do it as a conditional order. And let's say I go back to Apple and I want to sell my Apple as a trailing stop. So I could do a trailing stop order here, and maybe want a trailing stop market. So let's say buy at 170, and then when I'm doing my trail, I'm just going to set it up here and say, okay, I want to take the most loss I want to take is maybe $3. Okay, $3 delta. Now you'll notice as soon as I put this in, it adjusts the price based on this. But remember, it's not actually basing it off of this price. You really won't know what price the trigger is going to be based off because it has to wait for this order to execute. And once this order executes at that price, that would have meant that the stock has come down. That's when this order gets activated. And so if we're setting a $3 trigger delta, it really is going to be off of this price at that time because that's when this order becomes activated. And most likely the bid price will be, around 170 at that point. So you're looking at roughly 167 at that point. Okay. So don't be deceived. It's not really off of this price. In fact, this order is dormant. It's sleeping. Okay. Remember, it's an OTA order. So this is the primary order. It's going to be sleeping. It's not going to be active until this order gets filled. All right. So just keep that in mind. So that's how you would use that. You could also do, let's say we want to do FTO. So if we want to do FTO, maybe I want to set my trading stop limit order up here, and I want to do a stop market down here as my two orders. So buy me the 20, and then get me out and put a trading stop at we'll do $2 here and a trigger delta of 50 cents from this trigger price. Okay, and over here on the downside, maybe I don't know, 155. Okay, absolute 155. If it falls down there, get me out. So once this order executes, you can notice it's a bracket. This is why it's also called a bracket order. It's because it kind of creates this bracket, is what the visual looks like. And then this is an OR, so this is OCO. First triggers OCO order. Okay, so this order is the primary order. This OCO is sleeping until this order executes, and then it becomes active. And then it's going to be a race at that point to see what happens, where the stock is going to end up going first towards these prices, or is it going to go down to these prices? All right. And that is going to be that FTO order there for you folks. All right. Keep in mind, these orders only work for stocks and ETFs. They don't work for any other securities. They will work for options up to a certain extent, which we'll talk about next. Okay. All right. So with that being said, how is that? Is there any situations or scenarios you guys wanted to further explore? Any questions about any of the inputs that we have? Suat says, what's the difference between conditional OTA and attach? The difference, Suat, is just this. Remember, in a conditional, you have freedom of choosing any orders here. Okay, you can customize what type of order you want, the price type. In the attached profit loss, it's fixed. You see, I can't choose my order types here. It's always going to be set as a limit order, and it's always going to be set as a trigger order once I activate it. Okay, I can't choose this. So that's the big difference. The other difference is I can't choose buy and sell. It's always going to be based off this security alone. All right. In a conditional order, I can make it a different security. And this is useful, especially if you're looking to move from one security to the other, if you want to rebalance your portfolio, things like that. You could do that. Okay. Remember, in OTO, it's commonly used to buy and then sell, but you could also buy and buy, right? We could buy Apple and buy more of Apple. Maybe set a limit price there. Maybe I want to set another limit price at 155. Okay. So you could do that as well in these OTOs. So it really allows you to choose configure these, whereas the attached profit loss is fixed. Okay, so hopefully that clarifies that. All right, so is everyone good for a break at this point? How did everyone find that? I'm just going to just share WebBroker for a second. For, as I said, if you guys want to explore these, we have a learn section in WebBroker, which is fantastic. If you go to in our learn section over here, you can go to browse video lessons. And you can actually filter and go to yeah, I think it's under stocks, I believe, where they have these order types. You can go to stocks and apply filters, and it's going to show you once you go through it. There's order types which explains all the different types of limit orders, trailing stops, stop orders, kind of that video that I showed you. So if you want a refresher, you can definitely check in here as well and explore that. So fantastic resource over here. And then, of course, we have our masterclass. As I said, if you really want to spend some time on this one, if you go to our schedule, I believe it's under investing strategies, this course over here, where we do talk about these order types. So you'll find out in advanced trading strategies where we cover these, sorry, additional ways to trade, protective orders, stops and trailing stops, and advanced orders. We have a full 2-hour session dedicated to this, a lot more time than what I had today. All right, so you can definitely check that out. Next one we have is coming up on the second week of Jan in the new year. All right. So it says, is trailing stop based on highs after the order or based on 52-week high or all-time high? Suat, it's always based on highs of that day as the stock is trading. It's not based on any sort of historical numbers. All right. Hopefully that answered your question. Bill says, can you have more than one profit target? Can you have more than one profit target, Bill? So Bill, are you mentioning like can I put two different types of like, are you talking about in a situation like let me see what, like over here where you might want to set certain shares to be sold at this price and then other certain shares to be sold at a higher price? Is that what you mean? Yeah. Oh yeah, absolutely. For sure. I mean, if you do you so you wouldn't you could do it as a attached profit loss, and the only thing is if you go to conditional orders, we can possibly do it as an OCO. Well, actually, that'll cancel out that, but you'll have to put two orders in. It won't allow you to put. So let's say you buy 20 and you want to sell half at a certain price over here, right? Let's say 190, for example. You'll notice I can't put another order because you can't stack an order up, unfortunately. Like once I can't say like once this triggers, let this order execute and then trigger another one to do that. Unfortunately, you can't do that. So you'd have to set up a second order to dispose of the other order, the other half of that order. But you can certainly do that. You can split the share allocations up when you're initially setting it up there. All right. So just keep that in mind there. All right. Gary says, in your example, you used a margin account. Can you set up a trailing stop in your margin account, which triggers a sell, followed by an OTO, which triggers entering into a short position? So, okay, so you're talking about the primary order. Oh, okay, so you just want to do a sell followed by a short. Okay, I think I get what you mean. So yes and no. It's a little bit difficult, Gary, because when you want to do a short stock, when you want to short a stock, so I'm not sure if you meant like if you're long a position and you want to sell it and then you want to go short that position. Let me know if that's what you kind of meant. If that is what you mean, usually in a margin account, they separate the long positions from kind of the short positions. So you'll have to do it in separate accounts, which means they will be separate orders. So if you have a long position, you have to get out of the long position first. That's the rule. You cannot be long and short at the same time, although they're in different accounts. That's what's known as short in the box. That's not allowed. So you first have to be out of the long position, and then in the short account, you can go in and place your short trade to get in to basically do that. But that's the only thing, because they're separate accounts, it won't allow you to automatically sell out and then enter a short position in there, if that answers your question. Zhao says, can we change the attached profit loss after the first order is realized? Absolutely. Yeah. So by the way, guys, whenever you, sorry, let me go back to this one here. Whenever you attach this order, just because you're sending it right now at these prices, doesn't mean you can't change it. You can still go and edit the order after the fact. So if you notice that after this order executes, remember this is a limit. Let's say I want to do it a limit order to sell at 190. I can go in and adjust it. And if I notice Apple's climbing, I could go in and change this price after the fact, provided it has not executed. Okay. Then you can adjust it for sure. All right, so let me do a pause over here, and just in the efforts of time. Great questions. By the way, is everyone sticking around for the options section? I mean, we'll be able to cover that in a good amount of time. But is everyone staying around, or you kind of is I know options is not for everyone, so I'm just curious to see who's going to be around and who's not. But looks like everyone for the most part is going to be there. So fantastic. Okay. So what we'll do is I'm going to switch over to the break screen. We'll put a 5-minute counter on there. We'll come back in 5 minutes and we'll explore options there. Has sort of a foundational understanding of options. I'm going to put a poll up here because that's important, because we're not going to be, this is not a session where I'm going to be teaching necessarily about options. So I'm going to assume, when we talk about a call or a put and, talk about an option chain, that it. So just wanted to make sure that we're all on the same page. Does everyone here understand like the basics or the fundamentals of an option, how to read a quote and things like that? If you can just throw a yes or a no in the chat, be wonderful, so we can actually just jump right into the dashboard platform. Okay, perfect. So far, all yeses. Okay, excellent, great. All right, that way we'll just go right into it. I'm not gonna do any review or anything like that. All right. So with the session, let's go ahead and get rocking over here. So once again, when we're starting a new session, so I'm just going to mention again that any information I'm going to discuss from here is only going to be for educational, informational, demonstration purposes. And session options 301. Just take a note of that. We actually cover the concepts of what a multi-leg order is and how it works. I will show you how to do it. I'll keep it very basic, and I'll just show you how to execute it on the dashboard. But just you want to attend the options 301 when it comes to multi-legs, because I'll show you I'm going to be showing how that works. I'll just keep it confined to what we do know, however, okay? So we'll just have that in mind there, okay? So let me go into dashboard for a moment, and we're going to start exploring and show you a few different things as it relates to options. So I'm going to go back into screen share mode over here, and let's bring it up here. Okay, so I've got dashboard opened up here now. And one thing, let me just move my chat box over here so I can see the chats. Okay, so here is advanced dashboard. Now I've configured kind of my own screen for options, kind of the way I like it. Okay, so you remember if you had a chance to attend the advanced dashboard 101 session, it was all about customizations and setups. They would have taken you through how you can sort of build your own kind of design and components. Okay, so all I've done is I've added like a widget on the left hand side. I've got my option chain kind of here, and I've got some other component strategy chain and things like that we're going to explore. I'm going to just focus on the option chain for a moment, so don't worry about this side so much. So I'm just going to blow this up over here for a second, and then we're going to look at that. Anyone have any particular symbols that they want to look at when it comes to options? Anything interesting to look at? So just throw it in the chat and let me know if there's anything you want to explore in particular, so we can start with that. Kanti says BA. Okay, perfect. We'll look at BA. Boeing. Wonder what they are doing. I haven't looked at Boeing in a bit, but we'll start with Boeing. Okay. So, of course, I'm just going to plug in the symbol right up here. It'll load up Boeing. So, with the option chain, of course, this is kind of similar to WebBroker. This is your hub of where you're going to find all the quotes as it relates to Boeing. So over here, this is just this is the stock quote itself. Now, mind you, I've adjusted the font size, so you can go in here and I've made it to the largest, and I can I can make it bold, so it's a little bit more easier to see. So you can make those adjustments in the settings there if you wanted to do so. So whatever's easier on your eyes, so you can do that right there. You'll also notice this buy sell cover short alert. Okay, so you can set up the buys and sells right here. So remember how at the beginning I mentioned, like on this platform, you don't have to be glued to one area to just place buy orders, right? I can do it from the option chain. I can do it from my chart. I can go over here on any quote wherever there's displayed a quote and there's a bid and ask showing. I can place an order. And so if I wanted to buy Boeing stock like right over here, I could just click on the bid and it opens up this floating order window, order entry box. Okay, it's no different than the one we looked at. It's the exact same thing. If you look at it, attached profit loss is there, conditional orders are there. Okay, we're talking about options, so I'll get into that, but I just wanted to show everyone how you can do that from any screen really. Okay, going back to this, you'll notice there's a little graph of course over to the right over here, and there's different you can adjust from the line chart to make it a mountain chart, of course, and all that is just it's just colored in, of course. And then you can look at this one, HV and IV. Does anyone know, out of curiosity, does anyone know what HV and IV stands for? What is this and how to interpret, or what exactly it means rather? I think the name is right there, so it gives it away. But historical volatility and implied volatility. Okay, so what are they? Well, Kanti says no. Okay, so let me explain. So this is going to be useful for a lot of option traders. They do look at this, and so you can first of all, adjust the time frame or manner you're looking at, and so we'll keep it to 1 year. Historical volatility tells us, based on historical prices, what is the typical range at which a stock moves between? What's the price range? Okay, and it's expressed as a percentage. Okay, so you'll notice when you change it to this graph, it gives you a percentage, and so we could say, look, at this point in time, volatility jumped, historical volatility jumped about 45% over here, right? Sorry, that was implied. Historicals on this blue line over here, which is lower. 23%, and then it jumped up a little bit over here in August. So it's looking at previous prices and coming up with this range of where the stock kind of is bouncing between. Okay, and so uh, and so it's looking at previous prices. That's what it means, historical volatility. Implied volatility, what it means, or IV, is what a lot of option traders will look at. Based on all the option prices that get traded, it tends to predict where implied volatility, and implied means where the volatility may be going towards. Okay, so where is it at the time? And you'll always notice that implied volatility mostly is higher than historical volatility. And so right now, if we were to look at Boeing's volatility, implied volatility suggests about 35% volatility. Okay, and so when you're interpreting this, you're it's basically telling you where's the predicted price range of where the stock may go up. So it may go up 35%, or it may go down 35%, is what it's looking at when we look at implied volatility. All right, and so you will these are what these numbers exactly look at. Yeah, so Bill just says, is looking back, H is previous, and implied is kind of present or future, what it implied, what it may be. Okay, so you got it. So this is important facets that traders will look at when it comes to kind of predicting, where the price ranges are. Because at the end of the day, remember, when you're trading options, you're making decisions where you think the price is going to go, where Boeing potentially could go in the next month, 6 months, etc. in time. So this is why you'd kind of want to look at that. Now, the chain itself, when you come down to the chains, there's a few different configurations you can make here. So one I'm going to start with the strike prices. So you'll notice this 8 strike prices that are displayed over here because it's set to 8. I can click on this drop down. I can change it to 4. I can change it to 12, and then I can change it to all. Now you'll notice there's obviously a very big leap between 12 and all. So you're probably saying, well, look, what if I only want to see 20, or what if I want to see 15 or 16 or something like that? Can I do that? Well, you definitely can, because you'll notice there's a little blinking cursor in there, and that means you can type in there. And so I can go in and I can just type and say, okay, I just want to see, maybe 20 strikes, okay, and hit enter, and that way it'll show you exactly what you want to see. It won't come up in the drop down, unfortunately. So every time you just want to set it up the way you want and just type in that number, and it'll load up those specific strikes that you wanted to see there. Right. So this is what we have. The configuration is no different than web broker. So on the left hand side you have your calls over here. On the right hand side we have our puts. Basic information is displayed, so you'll have your volume, you have open interest, you have the current price, or the last traded price I should say. What is the difference in the change? So and then the bid and the current bid and ask. All right, that's showing on there. And so anytime you want to place a trade on any option contract, all you simply do is you click on the bid or ask depending on what you're looking to do. That's how you actually place the trade on advanced dashboard. So if I want to say, look, if I'm, today's not a good example, today's expiry, but let's just say I'm gonna buy the 200 in the money and think if it might be a push, and it's obviously not a good trade. Or actually I'll sell this contract, we'll sell this call, assuming, let's say I have the shares, just because it's 97 cents premium right now. So I click on it, I click on the bid, and what happens is the order entry box opens up, automatically defaults, so it shows me the symbol. It says sell to open covered is what it defaults to. I can change it to something else then from here. 5 contracts is my default because you can actually set up defaults on there. So if you typically trade, let's say 5 contracts or 10 contracts, whatever the case may be, you can just assign it as a default. So that way you don't have to keep changing this number every time. The expiry date is set, the strike price is set, it's a call I've selected, it's a limit. Now I can adjust my limit price to say, like, what do I want to sell it for? It's set to 98. I can obviously change it. Right now the bids moved up to 1 and 108. So maybe I could push my price to kind of the midpoint at 105. Try that. And then I just send the order through. Okay. It won't work for me just because we have a dummy account. And we've got nothing in there, so it'll reject the trade if I send it through. But that's all you would simply do. Okay, so if you want to do it now, just to someone's question, they were asking what kind of a can I set up conditional orders with options? And so if you can, so if you can do attach profit loss, and you'll notice that it gives you a few options here. It'll give you you can do an OTA, so you can do the sell and you can do the buy to close then after that as a limit price. However, you won't be able to do this one. This one won't work. It'll reject it. In fact, you see how the preview is not available? It won't work there. So you can just you can adjust your price, and let's say we put in a price of I don't know, if we're shorting it at 105, maybe to buy it back we want to buy it for cheaper at 50 cents. I can do that and preview the order. Okay, so this is an OTA. So OTA is the only type of order that's allowed in options. Out of our conditional orders, OTA is the only one that will work. So I mean, you could go in here and you could try it, and you'll notice there's only OTA option available given to you as well. You could choose a different symbol as well. That is possible. It doesn't make a whole lot of sense if you want to, sell BA and I don't know, buy another option or buy another stock. You could do that, but just keep that in mind. Okay. And so you could choose if you didn't want a limit price and you wanted the OTA to be something different, you can go in here. I can go to OTA and say, look, if I'm gonna sell this and I want to buy it back, you can choose a different option, market limit, and I think stop limit is what's allowed. These ones won't work, but if I could do stop limit, it will work. Stop limit will allow me to do that. So if I want to protect myself, let's say on the top side, because remember I'm shorting this contract, and so I could say, look, if it goes higher than 150, I want out and do an absolute buy at like 155. Okay, and I can preview the order. All right. So that's what you'd be looking at. Sorry, and I should change this to options there and buy to close. Of course, that's what I want to do. Match it up. I completely forgot I didn't do that because I changed it from conditional to OTO. Okay, so there we go. All right. So there's a stop limit given to us. All right, so you can do it in this sense. So this is what the conditional orders and how it works for options when it comes to it. Okay, if you're setting those up there. All right. Zhao says, what contracts I'm lost? Zhao, I'm just giving you an example of how you enter an order. Like we're selling a contract. We're selling 5 contracts of the Boeing December 31st $200 strike. All right, just an example. I'm just showing. All right, and I'm just illustrating that how you can do like the conditional orders on these. It's only OTA that's allowed with options. And then in terms of order types that you're allowed, you only have market limit and stop limit as available choices there for yourself. Okay, when it comes to these. All right, and then you just preview the order and send it through. I'm just going to exit out there, but and continue on. The other thing I wanted to show everyone that's pretty neat is on here, you can actually customize these views. So you notice, like, let's say I wanted to see some different information. So you can go up here where it says template, and advanced dashboard has some different views you can check. So we're on basic right now. I can switch it to extrinsic or intrinsic. So if you go here, it'll show you these values. It still shows you the price, the change, bid and ask, but it also shows you intrinsic and extrinsic. Everyone know what intrinsic and extrinsic means when it comes to an option? Everyone know what those values are? Jazz says no. Okay. We covered this in 101, options 101 session, but extrinsic and intrinsic value tells you if you're looking at an option price, it tells you how much of that, how the value gets broken down into. Okay, so intrinsic value is something that's considered known as in the money value. Okay, the option is in the money. So let's take for example this $200 strike price. Okay, right now the stock's at 252, and so we know it's in the money by roughly 52 cents. It just changed on me. So the intrinsic value is going to reflect that, okay? So it's going to be 52 cents. But the total worth of this option is right now is roughly, let's just say it's 95, kind of midway. So any value above the in the money value or intrinsic value is all considered to be extrinsic, which is comprised of time value and volatility, okay? So that's what this is. So generally, let me go back to BA. Just clicked on that option. So generally, when you have any options that you're buying and they're out of the money, they don't have any intrinsic value. They just have extrinsic. They just have extrinsic time value and volatility. Okay. So a lot of traders now, whether you want to look at that or not, that's up to you. I mean, it just it simply tells you is what's the in the money value. So if you don't want to do the math and say what's 255 divided minus 192.50, you could just set it up here and say, okay, well it's $8 in the money right now. That's what you would look at there. All right. So you could have that view. You could look at probability. Okay. So probability over here is actually a very neat tool. It doesn't work great with this option, so let me try and look at a further expiry over here. Let's go to the monthly in January. And so probability will show you three things: probability in the money, probability out of the money, and probability touching. All right. Now, what these values allow you to do is it tells you what is the likelihood of a particular strike that you're choosing, whether it'll end up being in the money on expiry day. Okay, that's very important. On expiry day, what's the chance that this option is going to be in the money? This does not mean it's going to be profitable. It just tells you that there's the percentage of chance that the stock is going to be at or higher than that particular strike price. So for example, let's say we choose the 202.50 in January. There's a 43% chance of it expiring in the money, okay, at that point. And then right now, of course, the probability out of that money is just the difference. 100% minus the in the money equals that, or however way you want to look at it. And so where a trader might use this is they might want to predict and say, look, I want a higher probability, if I'm going long, I want a higher probability that it remains in the money, versus someone who is shorting a contract may want to see that they're looking for a lower probability that'll go in the money. So they may set rules for themselves to say, look, I want a 30% or lower probability in the money option when I'm going to short it. Okay. So they would look at that. Probability touching means that at any point between now and this expiry day, what is the percentage or likelihood that this option is going to actually that the stock is actually going to touch this price? And so you can see the percentages are much higher. And so you can see roughly the way the probability touching is calculated is roughly double the probability in the money. Okay, so there's a 62% chance between now and expiry that this Boeing will hit 207, but there's only a 30% chance that it's going to expire in the money. Okay, so that's the difference what this probability touching means. Okay, so you can use these probability metrics to figure out where's the likelihood that a stock is either going to hit that price or not, or stay out of that price. Okay, so that's probability. So, and to answer Bill had a question, where is delta? That's going to be under Greeks. Okay, so there's another view called Greeks over here, and you can click on that. Okay, Suat's asking, I don't see any of these on dashboard. Do you have a different version? No, Suat, we all have the same version of dashboard. So it's on the option chain. So provided you got the option chain loaded up, one other thing you may need to do is there's a little bar over here. It's like a configuration bar. Sometimes it's hidden away where you can't click the template. So if you don't see where it says template, next to this Wi-Fi signal, just click this box and it should open something that says template. And then you can toggle between the views. Okay. So right now I'm looking at Greeks. All right, Bill, to your question. So if you go into Greeks, this is where you're going to see the delta, gamma, vega, and theta. That's a whole new discussion, but just for everyone's purposes, I'm going to briefly explain what these are, the Greeks. So Greek values basically tell us what influences the price of an option or how the price of an option gets influenced by different factors, okay? And so these factors are collectively known as option Greeks. And there's four factors in there, which is known as delta, gamma, vega, theta, and rho, actually five. Now, I'm not going to talk about rho. This has to do with interest rates. When interest rates move, in the overall market, how does that affect the option? So it shows here, interest rates barely move, so they're almost like negligible. They don't really impact it a whole lot. I'll quickly explain these four though, the main ones that are used: delta, vega, gamma, and theta. Okay. Delta, first of all, what is exactly delta? Delta tells us when it comes to calls, it tells us that with every $1 rise in price of Boeing, how much is the option price going to change? Okay, $1 rise tells us how much the option is price is going to change. So if you were to say, let's say you were to buy the 205 option, you're considering buying that. It's at 395 right now, and it has a delta of 39 and a half cents. Okay, so these are expressed as cents, by the way. When you're seeing this, it's cents. Okay, so if we see 39 and a half cents, it tells us that if the stock goes up by $1, if Boeing goes up by $1, this price of this option is going to rise up by 39 cents. So roughly it's going to be like four, let's just say give or take 410 to 420. Okay, is the new price of that option. Okay, so that's what delta tells us. It also tells us if the stock goes down, how's the price going to change? So same thing happens. If the stock were to go down by $1, this option will go down in price by this amount currently. All right. Now, the value beside that is gamma, and this is kind of like measuring the rate of change of the delta, okay? So this is like, think of the analogy of a car. You know, when you're speeding and you're accelerating, acceleration measures how the change in velocity, how fast you'll be speeding, right? And so gamma is doing that. It's measuring the change of the acceleration or deceleration of the delta. So what's going to happen is, let's say this stock goes up by $1. We know the delta right now is at 39 and a half cents. But after it goes up by $1, does the delta remain at 39 and a half? No, it doesn't. It changes. The delta value will become a new delta, and that's going to be based on the gamma. So this tells us, I did it again. Oh, this is so annoying. All right, let me go back here. I just click on this and it loads up the actual specific symbol. So, sorry, we are in January there. So let me go back to Jan. There we are. So it tells us that the gamma is about, let's just round it up to 3 cents, that if the stock goes up by $1, the delta is going to increase by 3 cents, and that's what the gamma. So the new delta would be roughly what, 42 cents there in that case. And so that's what gamma tells us. It tells us the rate of change on the delta based on the stock going up by $1 or going down by $1. Okay. Then the last two are vega and theta, and these are, V stands for volatility and T stands for time value. Okay, so it tells us that with every 1% rise in volatility, implied volatility, how much is the option price going to change? Okay, 1% rise in implied volatility and dictates a change. So if options, if the stock becomes more volatile by 1 more percent, in this case, this option is going to go up by 18 cents, and if volatility decreases, it's going to decrease by that amount. Okay, that's what Vega measures for us. All right, and so typically you'll find when you're trading options, when markets are really high or they're really, they've dropped quite a bit because that's volatility spiking, options tend to be expensive. They'll be more expensive during those times, and it's due to this fact that the Vega values are pretty high in comparison to where they typically would trade. And T is stands for time value, and this is something that's a big facet of options. Remember, whenever you buy options, if you're going long options, meaning you're buying options, you are working against the clock. Every time the closer the option gets to expiry, it is naturally losing a certain amount of value every day as it gets closer to the expiry date. And so theta tells you how much it's losing. And so we can see with this option contract, naturally, with everything being equal, meaning let's say the stock price got frozen where it is right now, nothing else moved, and we're just moving through the passage of time, this option is going to lose roughly 14 cents, 13 to 14 cents a day in value, okay, just based on time value, all right? And so a lot of traders will look at this, they will keep an eye on the theta because it works in their favor. They want the option to go down in value. They count on theta. Theta decay is what we call it. Theta decay is what they look for, okay? So you would look at that. So in short, these are what the Greeks are, and traders will use it in various ways. Now, Bill asks, how close would you say delta equates to probability? Bill, that's a fantastic question. In fact, what Bill is asking is, he's asking, well, what do these delta, well, Bill, to your question, delta is pretty much equal to probability in the money, essentially. So another way of if you wanted to predict whether this option is going to be in the money, you would look at the current delta, and that will tell you what's the probability that it's going to remain, it's going to go in the money on expiry day. So a lot of traders sometimes just look at the delta. In fact, on web broker, we don't even have probability option. Like you don't have a way of seeing probability in the money values. So in that case, on web broker, you would just look at the Greeks and look at the delta value, and that is going to tell you what is the probability in the money amount, essentially, if you convert it as a percentage. So you just basically multiply by 100 and make it a percentage. So this 39% and 32, etc., is what how you would interpret that as, right? Andy says, for these statistics, it is an accumulation of all price action for that stock's previous options. So are you talking about the probability, Andy? Or is there something specific, or the Greeks? Just let me know. I'm a little bit unclear on that. So could you explain Vega and Theta, please? Yeah. So again, Vega measures implied volatility and how it impacts the price of an option. Okay. So Vega measures with a 1% rise or decline in volatility, how is the option value going to change? Okay. So if volatility goes up by 1%, this option will go up by this many cents. Okay, on that contract. Oh bother, I got to turn that off somehow. All right, let's go back again over here. Sorry for that, folks. All right, let me go back here. Okay, there we go. Okay, I'll just be mindful not to click on that. So and same idea. Okay, so you'll notice that with Vega that it's different for different strike prices. So it's just measuring volatility percent rise. Okay, 1% rise in volatility increase the price results in a price increase in the options. Theta is a negative value. It shows negative, and that tells you it's a decay. It's losing value. So with every passage of time, as we get approach expiry, so today this is the option. Let's say we come on to the next trading day, which is going to be on Monday in the U.S. markets. U.S. markets are open on Monday. Canadian will be closed, by the way. So on Monday, the option, if nothing else moved, the option will have decreased by this many cents. Okay. Now keep in mind, it's not. I'm just explaining one by one, but it's going to be an amalgamation of all of these together. The delta plus the Vega plus the theta all combined together result in a change in price. Okay. So while you have a decrease in theta, you might have an increase in delta, kind of offsetting that. Okay, so it'll neutralize a little bit of those effects there. But this is what we're talking about when we talk about the Greeks there. All right, let me see what other questions we have here. All right, Farden says, can you go over the strategy tab on advanced dashboard, please? Yeah, absolutely. I will in a moment. So Bashu says, if you're trading options for income, delta would be a key consideration. Delta would be, yeah. So a lot of traders who are, looking at income are typically shorting options. They're shorting calls or puts and doing covered calls. They usually have a rule of thumb. When we had our options education month in June, we basically We had Tony Zhang, who's an options specialist. He's featured on CNBC and he does options play. He runs that program. Um, he would generally say like most traders who are shorting options will only look at strike prices with a 30 delta or less. Some really conservative traders even go 20 delta or less, just to make sure that that option doesn't expire in the money. Right? That the objective is we want it to just decay a lot faster, and so they would kind of use that gauge to do that. All right. Suet says, how can I see 4 digits after decimal place minus 2 digits? Absolutely, good question, Suet. So what you can do is that's found under settings. So if I go to settings over here, you might have this thing turned on. So if you click this on, what it's going to do, and I hit OK, you'll notice now it rounds up the numbers. Okay. So all you simply do is just go to settings, uncheck display maximum 2 symbols, and it's going to show you the total breakdown there up to a maximum of 4 there. Okay. Bill says rate of theta change each day and accelerates faster in the last 30 days. It does, yeah. So theta, time, it's not consistent. It's not a linear change. In fact, in typically when it comes to options, the theta decay is the most rapid or fastest in the last month of its expiry. Okay, in the last month that's left, there's significant decay, and if it's a longer term option, then the decay is a little bit it's less. It's kind of exponential in a sense. It kind of curves and then really falls off in the last month when it comes to theta decay there. All right, good question though. All right, one other thing I wanted to show just while we're on the options chain, just for this purpose, is like, so you have all these different ones. You can actually customize these views. So you know how maybe you want to throw a few different things in there, and so if you to do the customizations, you can go into settings. You can go into this section where it says template and go to manage templates over here. That's where you want to go to. And then what you want to do is basically choose new. And so it'll ask you to give it a name. And I already have a couple in here. So you'll notice that these ones are kind of colored up in this faint blue color. Those are the default ones, the system created ones. And anything in these ones are ones that I've created for myself. I've just labeled for myself. So I've got OTM theta. And for example, like what I have in there is and then you can go down and choose all the different columns of information that you want to see there. Okay. So you can throw that in there. I've got one on probabilities with some different information shown in there. I just did some test ones as well there, and theoretical pricing. So you can customize them and just chuck in whatever parameters you want, and then you can look under that view. There is one thing that I wanted to show everyone. Let me just see if I have Theo price. I think I might have theoretical price in there. Yeah, let's just throw this theoretical price in there. I'm just going to go to probabilities and go to theoretical price. Where is it? Where is it? There we go. Okay, this theoretical price. Okay, so you can go into Theo price. I'm going to just close this now. Now to save it, you just simply hit close. So once you've added everything in there, you have the ability to sort it out as well, right? So you can push things, higher or lower, whatever you want. So let's just say I want theoretical price to go kind of higher in the chain. So I'm just going to keep moving it up, and I want it to be kind of there. Okay, so I could, sorry, next to the last price and then the mark. Okay, so I have that. So I'm going to hit close. Now what I'm going to do is I'm going to go to my templates over here, and I can go to the one I was under. I think it was was I under probability? Yeah, there we are. Okay. So now that I've loaded this one, this is my custom view. So now I have the price, the Theo, the bid ask, the mark, high, low, and delta, and probability in the money. Okay. So let me go to the January option chain over here again. Let me open that up. Okay. So over here, what it's showing me is all the information that I wanted. All right. So it's very nice. So you can see the bid and ask. The mark. Does anyone know what the mark is, by the way? Anyone heard of the term mark? What is the mark when it comes to options, or really when it comes to anything really, any stock price? Kanti says no. Okay, no problem. So what the mark is, it's also known as the mid price. If anyone's familiar with the mid price is, and so what a lot of option traders want to do is if they see the bid and ask, you'll notice there's quite a bit. There's a huge spread. They always try and want to go in between the price to try and get a better fill. And so If you want to calculate what is the mid price between 880 and 905, it may not seem so obvious. Sometimes it may, but the mark just tells you what that mid price is, basically the midpoint, and it's 892 in this case. So this is one thing that I would definitely recommend for most of you guys if you are having an option chain to definitely incorporate the mark in there, because if you want to place a trade, especially if you're just doing single leg options, you know exactly what the mid price is, and you can try and place a price there. Now, I'm not saying that that's a guarantee that you're going to get that price. It generally it, the on a best efforts basis, you may be filled there at the mark, but you're not guaranteed to be filled at the mark price. Okay, so always good in that sense, because look, if you want to buy it, you can put it at a lower price, and if you want to sell, you can put it at a higher price, and generally you can expect a fill on very liquid stocks, okay, or very liquid options, which something like Boeing, Apple, all those big ones, you won't have a problem getting filled at. Okay, that's what the mark is there when it comes to it. All right, theoretical price is just the Theo price is just the actual price based on where the current stock is trading at right now, without once it expires with no time value left. That's what the expected price, is going to be on the option contract there. Okay, so that's showing you right now. You can see like for example, on this option it's 590 and 610. Well, the theoretical price is 605 right now, based on the current pricing of the stock there that we have. All right, this is for January, by the way. This is for January. All right, so we have these things. So let me just finish up in terms of this. I just wanted to show one last thing here, and then we'll look at strategy. So I just wanted to go to multi-leg over here. So for those of us who are familiar with multi-leg, and again, remember, I'm not going to teach multi-leg. I just want to show you how you enter it. You can go into multi-leg over here, and I can set up multi-leg orders. So let's say I want to do a basic covered call strategy. And so what I could do is a covered call involves buying the stock and then selling the call. Okay, so you could do it simultaneously. So you want to switch this to multi-leg up here to do that. Let's say I wanted to buy Boeing. I'm going to click ask. Sorry, I think I got to switch. Let me click the bid. Okay, I got the buy. All right. And now I can go to my option chain and say, let's say I want to do the monthly in February. I want to sell an option there. We're going to buy at 200. Maybe I want to sell something out of the money with a delta of at least 25 or less. So maybe I'm going to choose, just to be safe, I'm going to do the 225. Okay. So I'm going to go here. I'm going to click on the bid to sell that contract. All right, so this is a covered call strategy. It tells you right here, if you click on this, it gives you the profit and loss graph as well. It displays to you, it tells you the break-even prices. So based on this, if I'm selling this contract and I want to buy Boeing at this current time, it's telling my break-even price is 197.90. So it's taking into account the premium I'm getting from the call and the cost of the stock right now, and the net cost ends up being 197.90 for me. Okay, that's what that chart shows you. And max profit is 225. So if the stock does go up, I have a covered call. If it goes to 225, then I'll be called away, and my shares will be sold for me at potentially at 225 based on my call price. So he's saying this is my max profit over here, 13,555. Max loss is 98,000. Basically, this is the cost of the order, the total cost of the order at this time. If I were to buy 500 shares, and if Boeing were to go down to zero, then I'd be out 98 grand essentially. All right. Once you're putting your price in, you have this mid and natural. Okay. So it basically, because it's adding the two prices up together, it combined it. So you always want to do the mid. So the mid is a little bit of a lower price to pay when you're buying. So you could go just drag it down to the mid. You could create order, and it has everything set up for you under the account, and you can hit preview order. Remember, with covered calls, they can be done in a margin, they can be done in TFSA, RSP account, provided you obviously have the capital in those accounts to cover the trade there. And then you just send the order, and that's it. That's a covered call. All right. And then if you want to let's say you want to make some adjustments, of course, you can still do it over here. Maybe we don't want to buy 500, we want to buy 100 and do one contract. You can do that. No problem. Okay. So easily you can do that over here. Then I can just hit X over here. And let's say I want to do, I'll show you one more, which is like a common one, which is a bull spread strategy. So if you're bullish on the stock and you're looking to, um, you know, buy the stock, but you just don't want to buy a call. You want to have some protection by selling another call. That's what a bull spread is called. So let's say we want to buy the 210. So I'm going to click on the 210 call here, and I'm going to sell the 230. Okay. So this is called a bull call spread. So we're buying a 210 call and we're selling the 230 call. Now, whenever you do a spread order, the advantage of doing a spread is it reduces the cost and reduces risk, first of all. So you can see if I just bought the 210, it would have cost me $6. But now, because I sold the 230 as well, the total cost is reduced down to about $4 or so. Okay, so I'm taking on less risk, but still being able to have a bullish outlook. So I'm expecting the stock to go up, Boeing. I want it to go up by 210, at least to 210. But for me to make profit on this trade, and you'll see it right here on this graph when I show you, you add the total cost to the lower strike price. And so 214 over here roughly is going to be the break even. So if Boeing gets up to 214 by February, I'll start making profit. The higher it goes, the higher my profit. But the max profit I'll make is right up here once it hits 230. If it gets to 230, then profits stop, okay? Because this is kind of the ceiling now I put on there. This is what a spread order is. So it gives you some nice information over here. It'll tell you what the um, uh, max profit is on this trade if it gets to 230. All right, max loss is 2,230. So let's say Boeing doesn't get to 210 by the expiry date, which is 18th of February. Then I'll lose the total cost of this trade, which is 2,230 based on the 5 contracts that I have. It tells me my break even and the max profit price as well here. I can adjust my price to say, okay, well, maybe I want to do it slightly less at the mid. We'll go at the mid. You hit create order and send the order through, right? And that's it. We'll call spread there for you. All right. Bill says also limits profit. Yeah, exactly. It does limit profits there when you have this trade. Okay. As I said, it's very easy. All you're doing is whenever you want to add these multi-legs, just click on the respective ones. If you make a mistake, let's say, I ended up, let's say I go to the 230 and I hit the ask instead of the buy. It'll show you buy to open and buy to open, and you're like you realize, okay, that shouldn't be a buy to open. You can simply click in here and just go to sell to open instead. Okay, and they'll adjust it there so you can sort it out. But in this way, you can do a bull call spread. There's a bear put spread. There's a bear call spread, bear put spread. There's a strangle as well. Straddle, those are buying a call and a put at similar strikes or different strikes. So you can do those strategies. As I said, options 301, you're going to find that useful. So let's just, we can look at that there. The other thing I wanted to show you is over here. I'm just going to minimize this to show you the strategy chain because I wanted to just quickly cover this. I'm just going to use Apple just because we've been talking about Apple. Oh, don't do that one. So, and there's a Canadian symbol of Apple, but it's just, that's not the one you want. So if you go to strategy chain, what strategy chain allows you to do is if you're kind of wanting to get some ideas of what kind of strategies I can put on when it comes to options, you can go in here, you can put the stock up, and then you can choose, first of all, when you go to strategy chain, you choose your outlook. Are you bullish, neutral, or are you expecting you want to do a volatility trade? Let's say we're just bullish. Okay, I can click on bullish. When you click on bullish, it gives you all the bullish orders, all bullish sentiment option orders that are possible. Okay, so now you can say, out of these, which ones do I want to do? I want to do a bull call spread, and so I want to choose that, and then it'll show you just based on the expiry days. So you can choose either weeklies or monthlies or all of them, whatever you want. You can choose the width. So remember, a spread is a difference between the two strike prices. So if you do 1 point, this is $1. You could do $2, $3, $4, $5. Let's say you don't want to do 5 and I want to do a 10-point spread. I could do 10 and hit enter, and it'll give me 10-point spreads there. It'll basically create what's close to 10 points that I have available. And then these are all different ones that you can see, and then I'll give you a breakdown of the max profit, max loss. I think this is max loss. Yeah, max profit, max loss. I can expand these, of course. Break even price on the high side, etc. And so this is pre-built, and so let's say you find one you're interested in. These ones are a bit too expensive, so I'm going to go down with a lower debit, maybe the $7 one. I've only chosen 8 strikes, so if you want to see more strikes, of course you can choose more. But I'm just going to stick with this. Let's say we want to do this. We want to do the 172 and 200. So I'm going to click on this, and you'll see that it's buying an in the money 172.50, slightly in the money, and selling the 200 call. Okay, 5 contracts, and I can just hit create order and send this through. All right, so that's what strategy chain is. It just gives you that sort of some ideas based on these different types of strategies. It's nice because it also gives you price ranges, implied volatility. So this is nice because it tells you where the implied volatility range is, especially. A lot of traders will look for, when they want to short options, they'll look for higher volatility. And at that time, a lot of buyers will kind of wait for it to fall down in comparison to where it is. So this is kind of midway through, you know, equal. It's not bad for most traders right now to get in or short if they wanted to, but they'll keep this is just a range that provides it to you. Now below strategy chain, there's something called trade finder. Now the difference here is you're still choosing your sentiment. So let's say we're choosing our sentiment, but the only other thing the other thing that it also gives you is the time frame that you're looking for now. So here what it's going to show you is just based on your time frame, only those kind of strategies is only going to be mixed. So let's say we do 3 months over here, and I select 3 months. And so once you select 3 months, it'll just populate those trades. Or let's see if we can do 1 month. I'm not sure why it's not loading up right now, but basically it just shows you a mixed match all over here of, spreads, ratios, long calls, all of things kind of bundled in all together there. Okay, so let's just see buys. Doesn't seem to want to be responsive right now, but I promise you it does work. So just you can look at that and assign it based on that. When you're using Trade Finder, you just give a time frame and it just mixes everything in there for you. Whereas the strategy chain allows you to pick your strategy and then choose your time frame that you want it to do. So okay, so that's kind of the difference between the two there. Okay. All right. Let's see. Felucio has, hoping you can answer this question. For the losses on stocks in 2021, can I claim the losses in my 2021 tax without selling the stocks, or do I have to sell the stocks today in order to claim the losses? That's a good question. I generally don't want to answer tax questions, but just because I know this, so with any losses you have to claim, first of all, they can only be done in a non-registered account. That's very important. So you either have to have a margin account or a cash account, and in order to crystallize a loss, meaning crystallize for you to be able to claim it, you have to sell the security. You cannot do it if you're still holding on to the security. So I think Bill covered that for me, so thanks for that. So you have to do it, and it also has to settle. The other important thing in the trade has to settle is, so you can't just say I want to sell it today and I'm going to get it, because no, anything you sell today, if it's an option, it's not going to settle till Monday. And if it's a stock, it's not going to settle until Tuesday. So it's actually won't even count for 2021 year. All right. So just keep that in mind. The settlement period. So whenever, I think on WebBroker, if you had logged in, we had published about a week ago when the final dates have to be done to realize losses. And I think for the US markets, for options, it would have been yesterday. For stocks, it would have been on Wednesday on the 29th. And same thing for Canadian as well, because we're closed on Monday. So today's in fact the settlement date. So for stocks, you would have had to sell on 29th, and then options, you would have still been good for yesterday for everything to settle by today. Okay, so just keep that in mind. It goes by settlement date as well. It's not just the trade date to be able to claim that. Okay, so great question. Yeah, Dave says, I think I had to sell on 29 to be applicable for 2021. Yeah, if you're talking about stocks, yes, that's correct. Barton says, so Trade Finder optimizes strategy chain. Yeah, exactly. It just optimizes because it allows you to choose the time frame in there. And so once you select the time frame, it is just going to spit out just within, like, let's say if you're choosing 1 month, it'll be the next month, like just all of January, all different types of strategies. And so it mixes up all of these in there in Trade Finder. Whereas in this one, the big difference is you choose your strategy and you can choose whatever time frame you want here. All right. And in Trade Finder, you're just choosing your strategy because the month is already fixed. So that's kind of just the big difference between the two there. All right, so this is the main tools that I wanted to show you with this. As I mentioned, strategy chain, fantastic tool. So I'm just going to minimize this, and I have this view set up so you can always use it. Personally, most traders already know what they're looking for. They usually just rely on the option chain and go from there and look at it. But it's certainly an effective tool as well if you wanted to use that as well. Okay. So with that being said, I think I've taken up more time. I do apologize, gentlemen, and every folks who are still here. So once again,